Stock market investing follows two main approaches: prediction and reaction. The prediction approach involves trying to identify the next breakout stock, multi-bagger, or big winner before it happens. On the other hand, the reaction approach is about analyzing past market trends, financial data, and company fundamentals to make informed investment decisions after significant events. Let's break down both approaches with examples. A great example of the prediction approach is Amazon. A great example of the prediction approach is Amazon. When Amazon started, it was just an online bookstore. For years, it wasn't profitable, yet some investors predicted that it would become a massive company. If an investor had foreseen Amazon's potential and invested 3,500 rupees back then, their investment would be worth around 2 crores today. Identifying the right stock early and staying invested can generate massive returns. The reaction approach is based on analyzing financial data after a major event. A great example is the Nasdaq 100 crash in 2022 when the index fell 30 to 35%, pulling down top companies like Apple, Google, Amazon, Tesla, and Meta. Meta stock, for instance, fell by over 70% despite having strong fundamentals. At that point, a reaction-based investor would analyze the company's financials and recognize that it was undervalued. Those who invested during the crash made returns of 700% in just 2 to 3 years when the stock rebounded. Those who invested during the crash made returns of 700% in just 2 to 3 years when the stock rebounded. In India, Nifty 50 consists of the top 50 companies by market capitalization. If you separate banking stocks, you get the Nifty Bank Index, which includes major banks like HDFC, ICICI, Kotak, Axis, and SBI. Over the last 5 years, Nifty 50 gave 90% returns, while Nifty Bank gave only 59%. However, returns alone don't determine a good investment. Valuation metrics like the PE ratio or price-to-earnings ratio and the PB ratio or price-to-book ratio play a crucial role. The PE ratio indicates how expensive a stock is relative to its earnings, while the PB ratio compares the stock price to its book value. The PE ratio indicates how expensive a stock is relative to its earnings, while the PB ratio compares the stock price to its book value. A stock or index trading below its historical average PE or PB ratio is likely undervalued. Right now, based on valuation, some stocks are trading at 30 to 40% discounts, presenting great investment opportunities. So, which approach is better? The prediction approach can yield huge returns but involves high risk, whereas the reaction approach allows for data-driven decisions and is safer for most investors. For beginners, learning valuation metrics and identifying undervalued opportunities is crucial. If you want to learn more, check out my detailed videos on PE ratio, PB ratio, and valuation strategies. Links are in the description. Don't forget to like, share, and subscribe for more stock market insights.